The recent Fed meeting just killed one of the market's most favorite stories. The rate cuts are coming. Instead, the Fed held rates steady and signaled no cuts this year. Even left the door open to a rate hike if inflation does not behave. So in this video, we are going to talk about what that actually means for your mortgage and your credit card, your stock portfolio, and how markets have historically behaved in years when there is no Fed easing. Let's start with what the Fed just did. In plain English. Here's the short version of the recent meeting. The Fed left its main policy rate unchanged in the mid-threes for the fourth meeting in a row. They took out the language that suggested a bias toward future cuts. And in their projections, most officials now expect at least one rate hike before year-end instead of any cuts. Why? Because inflation is still too high for their comfort, and they would rather risk slowing the economy a bit than letting inflation get embedded again. In other words, the story shifted from cuts around the corner to higher for longer, with a non-zero chance of higher still. That's the backdrop of everything else we're about to talk about. Let's bring this down to where people actually feel it. Debt. Most existing fixed-rate mortgages do not change when the Fed moves. If you locked in a 30-year mortgage a few years ago, your monthly payment does not reset just because the Fed made a speech. Where this hits you is if you are trying to buy a home in the next 12 to 24 months. If you have adjustable rate or short-term floating debt, and on things like credit cards, personal loans, and line of credit. With the Fed saying no cuts and possibly one more hike, it means mortgage rates are more likely to stay elevated rather than drifting steadily lower. They can still move around day to day, but the anchor is higher now. Credit card and personal loan rates are likely to stay higher because those are directly tied to short-term benchmark plus spreads. And for anyone who was waiting to refinance into significantly lower rate this year, that window may not open as quickly as hoped. The message here is not panic. It is planning. If your budget assumed much lower rates soon, you may need to adjust expectations a little. Think about paying down the most expensive variable rate debt first. Being realistic about monthly payment if you are house hunting and not counting on the Fed to bail out your borrowing costs in the short term. Now let's talk about what you really care about if you are investing. What happens to the stock market in years when there is no rate cut? Two quick truths before we go into history. The relationship between Fed moves and stocks is not mechanical. You can have very good equity years with no cuts and bad equity years with lots of cuts, because cuts often arrive when things are already breaking. When the Fed does not cut in a given year, it usually means one of two environments. In the first, the economy is still strong enough that they do not feel pressure to ease. Growth is okay. Unemployment is low. Earnings are holding up. In that world, stocks can do fine, even with higher rates, because earnings and cash flows stay solid. In the second, inflation is the problem. The Fed is on hold or even hiking because prices are sticky, not because growth is booming. In that world, you often see more pressure on the long duration parts of the market, expensive growth and speculative stories, and more support for value, cash flow rich sectors and companies that can pass on price increases. Historically, when the Fed sits tight for a while at elevated levels, markets go through phases. The early phase brings anxiety to the market. In that environment, markets reprice the odds of cuts. Yields move up, and you often see pressure on risky assets. In the middle phase, investors start differentiating between companies that can handle higher rates and those that cannot. Quality and balance sheet strength matter more. And eventually, either inflation rolls over and cuts come, or something breaks and forces the Fed hand. That's when the narrative changes again. If you look back over past cycles, some of the better stock market years have actually happened before the first cut in a cycle, not after. By the time the Fed is cutting, it's often because growth deteriorating, which is not always a great backdrop for earnings. So a year with no cuts and the possibility of a modest hike doesn't automatically mean a bear market. It more likely means a tougher environment for richly valued speculative names. Quality, cash-generative businesses tend to get more support. This puts more emphasis on sector and factor positioning, rather than just buying beta and hoping rate cuts do the work. Let's translate all of that into something you can actually use. In a world where the Fed is on hold with hawkish bias, cash and short-term bonds become more attractive as a place to earn something without taking massive risks. Yields on money market funds and short duration paper stay interesting as long as policy rate is elevated. Long duration assets, think long-term growth stories with profits far in the future, or very long dated bonds are more sensitive. If the market has to price in a higher terminal rate, their valuations take more strain. Quality and balance sheet strength tend to matter more. Companies with strong free cash flow, manageable debt, and pricing power are better positioned to live with higher financing costs. So instead of a portfolio built purely around the idea that Fed will cut and everything will rip, you might think in terms of keeping a deliberate liquidity buffer so you are not forced to sell in volatility. Make sure your fixed income exposure isn't all in the longest dated stuff that gets hurt most by higher yields. And be honest about how much of your equity exposure is in names that only work if money stays free. It is less about predicting the exact path of the Fed and more about asking one question. If rates stay here or go a bit higher for longer than I'd like, does my portfolio survive? Markets love a simple story. And for the last year, the simple story was rate cuts are right around the corner. The most recent Fed meeting basically said, not so fast. That doesn't mean panic, and it doesn't mean sell everything. It means stop building a portfolio that only works if the Fed bails you out on your preferred schedule. If you're tired of the hot takes and want markets with actual math, hit subscribe and let the algorithm know you prefer facts over vibes. And I will see you in the next video.